So in this discussion, we're going to be reviewing the General Ledger for 2006. Up until now, we developed a hypothesis based on reading the case, understanding the business, and listening to the story and the complaint of the new owners. We've seen some strange patterns in the analytical review, which was the prior discussion. If you haven't reviewed that, go do that first and then come back here. And so now we're going to dig a little deeper. We're going to look at the actual general ledger to see if there's any detail in there that would shed light on why the financial statements look like what they did. So you have a file, Appendix B, that was sent to you, and so you can open it up and you can look at it. Here's a little piece of the top of the first page, and here is the activity in the checking account. So there's a journal entry with absolutely nothing written in it. The journal entry type is missing, the date is missing, there's no text in the journal entry, so it's just a completely blank journal entry. All it has is a debit amount, and then there's a credit amount, and they don't balance, so they're not. So there's lots of other parts to this journal entry, assuming that it balances. And so what they have done is they have done one journal entry to record all of 2006. So that debit is all of the deposits for the year, and that credit is all of the payments for the year. So I've done sort of a mock-up of a sample journal entry down here, and so they're debiting cash for all of the receipts. So the receipts would presumably be what customers had paid, maybe the proceeds from a loan, that kind of a thing. And then all the payments, and all the payments would be for the various expenses and any assets that had been bought. So that's what you're looking at. It's very strange. And then below it, here in inventory, we have an adjusting entry where they actually did put some details into the entry when they typed it in. And it was made in February of 2007, so they were closing the books in February. That's probably about the right time frame. And they have debited cost of goods sold in that particular entry. So we don't have the other side of this entry. It takes several pages to kind of get all the entry trotted out, and so it was hard for me to follow what was going on. So what I did was put all the debits and credits of the entry into Excel so I could kind of inspect them. So I did something like this. I went and got every time there was a debit or credit to one of these accounts. So we see a debit to the equipment account. We see here a credit to accumulated depreciation, and this is an adjusting entry. I went ahead and accumulated all this data one line at a time until I had all the debits and all the credits from the pages in the 2006 general ledger, so I could kind of get a look at it. So this 27,894, you see it here. I've recorded it as a debit to inventory. It's part of the February 18th journal entry, and I had to keep going to the rest of the pages to get the rest of the entry. So here is the entire entry for the bulk activity for 2006, and then there were adjusting entries made on 3 separate dates, or at least they were dated 3 separate dates. We don't really know what day they actually made them. They just typed in the date that they wanted to put. So it looks like there was one during the year, and then there was one in February, and then about 2 weeks later there was another one in March. It's hard to look at this massive group entry and see that there was anything necessarily right or wrong. We do see that there was a debit to cash and a credit to revenue of a slightly smaller amount, and some credit to interest income. And then there were some activity here in the liabilities. So it looks like they borrowed $20,000. It looks like they reversed last year's accrual for payroll liability and put in this year's. Reversed last year's liability for sales taxes payable, put in this year's. Not sure what this churning of long-term debt is. If they borrowed off the line of credit, maybe they had an additional loan of another $10,000. I guess that nets to. They have a payment for dividend. I'm not sure why they would be debiting retained earnings, so they're putting some expenses that they paid this year into last year's. So some of the payments here may have been related to last year, and probably not the best practice, but looks like that's what they did. And then you can see all the expenses during the year that they think belong to 2006. And then the adjusting entry, they reclassified something that they paid for as just an expense and not something that's a depreciable asset. They recorded their depreciation for the year. They recorded inventory. They probably had a count at the end of the year, and so they've written up inventory to what was actually counted. And then here they've reclassified the loan that they got over here as a payroll liability. That looks a little strange to me. And then that the loan that they made to employees, that gave some cash to an employee, they're writing it off, but they're writing it off against sales. So it's not a repayment where they would debit cash and say, oh, that wasn't a loan, we got that wrong. They're actually writing it off to sales. So that's a little strange. I would have some questions about that. In terms of this debit to inventory and credit to cost of goods sold, we need to review their treatment of the pawn inventory. So let's do that now. So what would be the correct treatment of the pawn shop activity? This is not what they did, but let's just review what they should have done. A pawn shop gives you a loan against an item that you bring in, and if you repay the loan, you get the item back. If you don't repay the loan, then they get to keep the item, and you have a certain number of months, or term would be determined by the deal when you brought the item in. So when a customer brings in an item and gets a loan, they get cash, and you should be recording the IOU, the accounts receivable, and showing the cash payment. Then when the customer repays, you've got cash and you relieve the accounts receivable. It could be that they're paying just some interest, which would be a debit to cash and a credit to interest income. If the customer does not pay, then you would remove the IOU. They don't owe you anymore, but now you have the item that belongs to you. So now you have inventory. So you would write off the accounts receivable and record it as inventory. Now that's not what they did. Let's look at what they did. So their current practice is when the customer brings in an item, they actually debit purchases as if they had bought inventory, and they credit cash. And since they moved to the periodic system, when you debit the purchases, that's going to commingle the loans from pawns with items bought for the rest of the store. Won't be able to distinguish the two. And then when the customer brings in interest, when pays interest or repays a loan, they debited cash and credited sales. They didn't credit AR. So there's no tracking of what customers owe you for pawn loans. And then when the customer doesn't pay and the item is forfeited, there's no entry at all. It's totally invisible. So let's go back. So there should be a listing of customers that owe you money. There should be a listing of forfeited items. And those should both be on the balance sheet. They're not on there because they have just basically written off all the loans to cost of goods sold. And then when cash comes in, they record it in sales, so it looks like it's sales from the store as opposed to sales from pawn or interest income from accounts receivable loans. And there's no list of unsold items in the pawn shop. So we have some questions now, and we will make a record of these questions so that when we interview the employees we can ask. So we want to find out who was the loan to and why was it written off against sales. We want to know why the line of credit borrowing was reclassified to payroll liabilities. And we want to know what level of receivables there were, how many pawn items were forfeited that are still on hand, and are there any payments that were not recorded, because customers were allowed to pay by check for interest income but not for repayment of loans, so there could be cash that wasn't recorded. Very hard to find that, but we can ask in the interviews and see what can we find out about the missing activity and these two entries that we do not understand. Next we'll be moving on to the 2007 general ledger and inspecting that.